Welcome back to Homebuyer University. Today's episode, we're going to be talking about why you shouldn't put 20% down on your home.
Now, this might sound a little bit crazy or a little bit different than what you've heard in the past. So let's kind of break this down and be extra thorough about what this actually means. This message specifically goes out to those of you that have that 20% down payment. And the reason why is because you have more options than you've traditionally been told that you have. What if we told you that there's a way for you to put less than 20% down and have the same monthly payment that you'd have at 20% down, while also keeping some extra cash in your pocket because you didn't put down that full 20%? You'd probably say that doesn't sound so bad, right? Well, let's kind of dive into what it means and how you do it.
Let's put a caveat on this. This may not be right for every single person, and it really is going to depend on your unique situation. For example, let's say you're moving into a home that requires a little bit of TLC or some extra handiwork after you move in. This option allows you to keep some of that cash as well as have a similar monthly payment than you were expecting with the full 20% down. Or this could be for you if you simply like having a little bit of extra cash on hand to increase the size of your safety net.
Let's talk about how this functionally works. So instead of putting 20% down, you're going to put 15% down. So you have 5 extra percent on hand to have as that extra little cash safety net or rehab money. Now, you already are probably thinking at 15% down, I have a higher mortgage and I also have mortgage insurance. How is my monthly payment going to be lower or stay the same? And this is kind of where that magic happens. With that extra 5%, we're going to use portions of it to invest in buying the rate down as well as buying out the mortgage insurance. Once you've bought those two pieces out, you'll have a couple percent left over, so you'll still have that cash safety net. But now, due to getting rid of mortgage insurance and reducing your rate, your monthly payment is pretty much commensurate with what it was at 20% down. So this is that good little hack to say, hey, how can I put less down, keep more of my own money, but still have a similarly low monthly payment to that 20% down? Let's take a look at how those numbers work so you have a tangible side-by-side example to understand what we're talking about. Okay, let's take a look at some numbers together. I want to build out a scenario where we look at the traditional 20% down method to the lesser known 15% down strategy. We'll start at 20% down and we'll use the same purchase price of $500,000 in both scenarios. So in this first scenario, 20% down and a purchase price of $500,000, your down payment is going to be $100,000. Every loan when you purchase is also going to have closing costs. Closing costs in a scenario like this will roughly be about $7,000 additional dollars, making your total cash investment about the $107,000 mark. What does this mean for your monthly payment? In this scenario, we'll use a rate of 6.375%. So what is your monthly payment made up of? The first thing is going to be your principal and interest. This is the bulk of your mortgage payment. And in this scenario, that mortgage payment, the principal and interest itself, is going to be $2,495.48. You will also have property taxes. And for a home at $500,000, you're looking at about $520.83 a month for your property taxes. You also need to have homeowner's insurance, and that insurance comes out to about $100 a month. This makes your total monthly payment come out to $3,116.31. So, how does that compare with our 15% down method? At 15% down, our upfront investment for our down payment is only going to be $75,000. Closing costs will be about the same, around that $7,000 mark, so not much variance there. However, this is where it gets to be a bit unique and gets to be a bit fun, because we put less down, which means we have approximately $25,000 to play around with. So how do we best use that? First, we're going to buy out mortgage insurance. At 15% down, you do have a monthly mortgage insurance payment. However, you get a big discount if you just pay for it in a lump sum up front. And in this scenario, that's about $1,300. So, no mortgage insurance on a monthly basis because we just bought it out at a discount. We will also buy our rate down. So to buy the rate down, we are going to spend 2 points. What does 2 points come out to? It's approximately 2% of your loan amount. And in this case, that's an additional $8.5 thousand. This means our total out-of-pocket investment is approximately $91,800, give or take a little. So up front, we are already saving more than $15,000 out of pocket. So take home, we get to keep $15,000 more of our own money. You might be thinking though, what does that mean for our monthly payment if we're putting less down? This is where it gets fun. Because we've spent the money buying our rate down, our new interest rate is 5.75%. So our monthly principal and interest in this scenario comes up to $2,480.18. The property taxes stay the same because they're based on the purchase price, not your loan amount. And that comes out to that same $520.83. Insurance stays the same. And remember, we have no mortgage insurance. So that new total payment that we're paying in this scenario is $3,101.31. This is a savings of roughly $15 every month. So not only are you saving $15,000 up front, your monthly payment is also less. This is a great way to spend less up front, keep more of your own money, and also spend less every single month moving forward. As you can see, the math is mathing, as the kids say these days. Your monthly payment is about the same as it was with 20% down, but you're keeping more cash in your pocket. And this is a great option that you may not have been privy to before, but may work for you. So when you're out there shopping, just know this is an option that could be employed for the right property and situation.